Traders face off losing money on every single trade, and even the most successful ones are almost constantly putting money on losing trades. Being a winner trader over the long haul is a function of your winning percentage and how big your wins and losses are. If the risk can be managed, traders can open themselves up to making money in the markets. It is essential but often overlooked prerequisite to successful active trading. After all, a trader who has generated substantial profits can lose it all in just one or two bad trades without a proper risk and money management strategy. Money management. Money management, in the traditional sense, basically means being able to manage your money efficiently. Being aware of money management rules can make you a better trader. Money management is what allows you to protect your capital and also optimize your trading performance. If you don't apply strict money management rules, you can't win on the financial markets. Technical analysis saves your money and money management prevents you from losing too much. Managing your risk well means having the right position sizes, which is 1% rule, also knowing how to place and move your stop losses, and taking into account risk and reward ratio. Money management allows you to trade without stress. Risk management is what makes difference between the winning and losing trader. If you are new to financial markets, your goal should be not to make money, but not to lose money. Money management is used to manage losses and prevents you from raising your account when you are wrong and consists of basically four major things. First, size of your deposit. If you cannot handle small account, what makes you feel that you will be able to handle huge account? You know that you must start little, with the amount which is comfortable to lose to you, or at least it won't affect you. That will help you to be focused on your system and approach to trading, and not to money itself. If you will be able to handle small account, you will be able to do the same with a large account. Unless psychology kicks in. But I hope until this point you will be able to deal with your inner self and you will focus on the game itself, rather than money. For example, if you start with a few thousands, I understand that it might be frustrated to see your capital grow only a couple of hundreds per month. But what is important to understand, that these couple of hundreds are 10% of your depot, and when you will trade with 300k of depot, this 10% per month is 30k, which is not that bad, right? Therefore, at the beginning you must focus on the system and approach to trading. If you will be disciplined and consistent, your time will come. Another thing, risk per trade, 1% rule. We've discussed that rule already. It is key for right money management and protects your capital. Third, risk reward ratio, 1 to 3 ratio rule. Right risk and reward ratio gives you many advantages. It lets you grow. 1 to 3 ratio is minimum that you can apply to your trading. And lastly, risk limitations. There are dark days in trading when no matter how many trades you do, we all lose. That will happen to you as well. This should be integrated and accepted. This does not happen often, but every trader going through this occasionally. Seems like market against you no matter what. The important thing is to protect yourself psychologically by limiting losses during these days, and be able to return without taking additional risks during the following days. It is therefore important to set your maximum daily loss, which you can accept. Once this level is reached, you simply stop trading at the day and come back the next day. Every trader should have a maximum daily threshold. This is a very important element of risk management that can save you from raising your trading account. This is the threshold at which you stop trading. This therefore requires comprehensive risk management. For example, if you reach 3% loss during the day, you stop everything. The maximum level depends on each trader. It simply has to be the level that you feel able to cover quickly. If you allow yourself to go high, it may be difficult to manage psychologically. And you know, when emotions comes into play into your trading, it's the end. Losing 5% on a trading day is not tolerable. It's too hard to take. To catch up, you will want to increase your leverage, or size of contract, or something. that ultimately raise your trading account. There is a rule to follow in order to limit yourself at these losing strikes. 3 loss rule. When you have 3 consecutive losses in a row, close your trading platform and go do something else. Even if you still have this urge to trade, because you think profitable trades is almost there, or worst, you have urge to get back your money, whatever feelings, thoughts you have, close your trading platform and forget about trading at least for a day. Market is just against you, against all odds and predictions. There is nothing you can do. Do not think that you are a loser or trading is not for you. As it was mentioned, that happens to every trader, no matter how successful you are. Therefore, practice 3 loss rule and make that as an automatic mechanism to your trading system. As every rule we've discussed so far, it is not made for no reason. It is made to protect traders from unnecessary losses. Sometimes can happen when you receive 3 losses within an hour. Even then, stop yourself and do not trade at the day, even though trading day is just started. 3 losses, it happens not all the times in a row. Sometimes you get 1 loss, another is 0 trade, then again 3 losses. That applies to those who are using stop adjustment rule. When a price moves into profits for a few stops, then you adjust your stop into no loss area. So how to act in those situations? Because it's not quite 3 loss in a row. Despite that interruption, with no loss, it still counts as a 3 loss day. You must put your weapons down at the day. Sometimes can happen when you receive 3 loss rule days in a row. If it happens 4 days in a row, 4 days with 3 loss rule, lower size of contract. Lower contract size quite heavily, or move back to demo if what is necessary. That much of losses in a row is not healthy. Something is wrong. Either market condition changed, which requires different approach and you are not adapted to it just yet, or might be economically intense period, resulting high volatility which swipes out your trades, or simply you making mistakes. Take step back, re-evaluate your trading, look from different perspective, take time off to build yourself back again, find those problems, and back to trading with your full attention when things get better. It might take to trade for a week or so at the demo, but nothing wrong with it. Lower size of contract rule can be applied when you get 3 losses in a row, but you're still going to trade, despite all the recommendations and rules. If you cannot help yourself, at least lower contract size, to protect yourself in that way. Anyway, it is not recommended, and remember, that is not about money. Risk management. Your money in trading account is your risk for which you need to apply appropriate risk management rules to protect yourself, and also grow your capital. Plan the trade and trade the plan. Remember we already spoke that you should give decent preparation before trading. In other words, there should be plan of actions which includes risk management as well. Stop loss and take profit points represent 2 key ways in which trader can plan ahead. Successful traders know what price they are willing to pay and at what price they are willing to sell. They can then measure the resulting returns against the probability of the stock hitting their goals. If the adjusted return is high enough, they execute the trade, and if there are no space for appropriate profit, trade won't be executed. Conversely, unsuccessful traders often enter a trade without having any idea of the point at which they will sell at a profit or a loss, like gamblers on a lucky or unlucky stake. Emotions begin to take over and dictate their actions. Losses often provoke people to hold on and hope to make their money back, while profits can entice traders to imprudently hold on for even more gains. Sounds familiar, right? There is no way to avoid risk in trading. Every single trade could, theoretically at least, end up in failure. In fact, a successful trader can lose money on trades more often than they make money, but still end up ahead in the long run if the size of their gains on winning trades far exceeds the losses on their losers, as we know already. Another trader can make money on majority of their trades and still lose money over time by taking small gains on their winners and letting losing trades run too long. The first key to risk management in trading is determining your trading strategy's win-loss ratio and the average size of your wins and losses. If you know those numbers and they add up to long-term profitability, you are well on your way to successful trading. If you don't know those numbers, you are putting your trading account at risk. We already know our minimum risk-reward ratio, which is 1 to 3. That 1 is our 1%, and that 1% is our stop, and stop is our risk, and our risk shouldn't exceed 1%. Simple. There are two types of stops, fixed stop and technical. Fixed stop is our 1%, but recommendations is to use technical stop as much as possible, only if opportunity allows to do so. But all of that you know already. Stop is quantity of points you allow market to go against your favor. Quantity of points you know already by your fixed stop. What you need to determine is size of contract in relation with stop and risk of capital. Size of position. Here will be provided a simple formula of setting maximum contract size in relation with stop size and risk per capital. Depending on a broker and a market, value of point could be way different. Of course, if it would be futures market, value of point would be fixed, as well as with stock market. For example, stock value is $10.2, and you bought 100 shares of company. Then 100 multiplied by 10.2 equals 1020. This is the amount of money you have to have in order to open position without leverage. But without leverage is another story. From the very beginning, you need to use leverage in order to grow, but with proper risk and money management, of course. Trading without leverage has many advantages. One of them, that your risk to lose the whole capital is very small. However, that it doesn't protect you from losses and you must manage your risk as per rules. So let's say stock value grows up to 10.8 and your position value is 100 times 10.8 equals 1080. That means your profit would be $60. That kind of positions you can trade from the very beginning, with small deposit and leverage not exceeding 1 to 10. You need to take a look what price per point, depending on contract size, is on each security you are planning to trade with. That information you will find in each individual broker, which one you are trading with. Let's say we are started with CFD broker, and our deposit, which we are planning to start with, is 10,000 euro. That means 1% equals 100 euro. Let's calculate contract sizes for 3 different securities: stock, futures indices, CFD contract, and crypto. Tesla stock, leverage 1 to 5. 1 CFD equals 0.92 euro per point. Our fixed stop is $1. Because of the market volatility, we are able to set fixed stop bigger. Nasdaq 100, futures market, 1 CFD equals 0.87 euro per point. Our fixed stop is 40 points, 0.2 value of market. And Bitcoin, 1 CFD equals 0.92 euro per point. Maximum stop is 120 points, 0.2 value of market. Quick setup formula: 1% equals max stop times contract size, 1% of the whole deposit. Contract size is the one we are looking to find out. Then would be contract size equals 1% divided by stop size times point value. Contract size of Tesla equals 100 divided by 1 times 0.92 equals around 109. Contract size of Nasdaq 100 equals 100 divided by 40 times 0.87 equals around 3. Contract size of Bitcoin, 100 divided by 120 times 0.92 equals 0.77. Once again, it is very important to find out value of point. That information is available at your brokers. For example, if you are planning to trade full futures with futures contract, where each point worth $20 for the same Nasdaq 100 market, then your contract size would be 100 divided by 40 times 20 equals 0.125. With your deposit, you will be able to trade only a small fraction of contract. Broker would be also different, because CFD broker usually not provide that services, or if provide, then you have to change type of your account. Also, most of the times it is not possible to buy or sell fraction of contract. I'm pretty sure you understand that to trade futures is pretty expensive at the beginning. You could set up your maximum contract size for each stop, for example for 20, 25, 30, 35, Nasdaq's 100 futures market, in order to keep 1% for each trade, no matter how small it is, by creating a quick setup table or something. Anyway, I do not suggest you to do so, because it might be too complicated. Way better is to set your maximum contract size and to trade with it for each trade, no matter how small or big your stop might be. Keep in mind that you cannot increase your fixed stop and never risk more than 1% at the beginning. Risk tolerance. There is something more to discuss when it comes to stops. If you don't place a stop loss, your emotions take control of you when there is unfavorable price movement, and this is the beginning of the end. A single trade can be enough to ruin you, even with low leverage. Don't believe that the price will always come back to your entry price. Some trends last several days, weeks, months, or even years. A stop loss must never be moved if the price moves in the wrong direction. The stop loss level is decided before the position is taken. This is when you are most objective. Only a favorable price change should involve moving a stop loss to follow the movement and protect your gains, as we already established the relevant rules for this. Another thing is stops at local extremes. Local extremes, so-called local maximums or minimums. The word local says itself that it is not necessarily all-time high, or some low during recession which wasn't seen in years, for example. Local extreme could be area where there is no support or resistance from technical side. For example, price breaks above and there is nothing potentially could stop the price until it reaches another technically strong area or it begins to form itself. That applies to all-time highs as well. For example, our fixed stop at Nasdaq's 100 futures market would be 40 points. However, even if there is no possible to use technical stop, when there is no place to attach for, even then I would use stop of around 20 to 30 points. Reason behind is simple. Firstly, trend is usually not in our favor, and price at local maximums and minimums intends to break. That means there is no point to keep fixed stop if we know that it is potentially dangerous area. A lot of time, price moving above, below the local extremes, and any size of stop would be pulled anyway. Of course, other technical aspects are important as well. Let's get to the chart to see the situation in live market. It is Nasdaq's 100 futures market at hourly time frame. If market crosses this blue line and stays above, then market would be in all-time high. So if market will reach all-time high, then technically there is no ceiling to stop that movement. No one knows when it stops. However, there is area where we can take a short trade. Normally, due to this movement up, there would be no possible to use technical stop. We would be forced to use fixed one. But we know that it is all-time high area, and price might continue to move higher. Therefore, we protect ourselves by attaching stop to this peak, about 25 points. Let's move to the right a bit. We receive a signal and open a trade right here. However, as you can see, market breaks above and moves way higher, since there is no ceiling to stop that movement. Consider asset volatility. The more volatile an asset is, the greater the risk that your stop loss will be triggered by volatility movements. Especially after major key time events, when volatility is high, you must take into account that your stop might be quickly pulled by volatility movements. In that situations, suggestion would be to keep your stop as small as possible to protect yourself from bigger losses, or to wait a bit, up to 10 minutes after major event release, until this uncertainty dissipates. Or if you focus on long time units, swing trading, On a volatile asset, you must therefore place your stop further away to avoid unnecessary loss because of volatile movements. A lot of times, price moves into your predicted direction before pulling your stop loss. Therefore, a recommendation would be to keep your stop bigger if opportunity allows itself, but within the risk management rules, of course. Slippage. Sometimes will happen situations when you open trade and your entry price slipped quite far, where you not expected. What you should do in these cases? The only thing you can do and must do to accept what you get and never adjust your stop further away to compensate that slippage. The rules doesn't say anything about adjusting your stop loss further away even in those situations. Do not let your emotions dictate your actions. That is a nasty situation, but you must accept that. Period. Another, even worse situation that might appear when price gaps or jumps right through your stop without executing it. Usually, that happens after major event releases. You know already that you must avoid that kind of times. Anyway, if situation did happen to you, close your trade immediately. Sometimes, trading platform executes your stop with much worse price rather than the one you were willing to take. But sometimes it stucks and you must execute it manually, as soon as you can. Do not wait until price returns, just close your trade and accept it. I know that it is tough to do psychologically, but it is what is necessary to do. Once again, risk management involves limiting your positions, usage of capital with clear boundaries, and approach to risky situations with clear set of predefined rules. Risk and money management rules are golden rules and should never be broken. Let's quickly recap what is the most important in terms of risk and money management. Always use stop loss and take profit. 1% rule. Never risk more than 1% of your capital at any given trade at the beginning. Stops. There is two types of stop, technical and fixed stop. Fixed stop equals to 1%. Use technical stop as much as you can. The smaller the stop, the bigger chances for positive trade. 1 to 3 ratio rule. Your take profit must be at least 3 times as your stop. If there is no space for take profit, trade shouldn't be executed. Never adjust take profit rule. Stop adjustment. Price moved into take profit in size of 2 stops, then stop might be adjusted into no loss area before key times and signal in opposite direction. Risk limitations. Free loss rule, 4 days with free loss rule, lower contract size rule. Size of position, contract size calculation, stops at local extremes, consider asset volatility, slippage. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you'd like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.